Hey everyone, welcome back to Corporate Decoder. Today, T. Rowe Price Exchange, Traded Funds Incorporated just filed its latest N-CSRS report, and I'm seeing a few interesting dots connecting in their holdings. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing gives us a snapshot of the global equity ETF's investments and financial health, and it reveals a clear strategy in how they are playing the global market. Let's dive into what the fund was invested in. The biggest chunk of their money, almost 32%, was in information technology companies. This tells us they are betting big on technology driving global growth. Right behind that, nearly 17% was in financials, which makes sense as a backbone to any economy. Then comes industrials and business services at over 12% and consumer discretionary at 9%. They also have a decent portion in communication services and healthcare. What is interesting here is the mix. They are not just chasing one hot sector, they are building a diversified portfolio across key areas of the global economy. Now for the big players, the top holding by a good margin is NVIDIA, making up 5.6% of the fund. This is a massive bet on the AI revolution. Following closely are Advanced Micro Devices and Apple, both commanding over 5% of the fund. Broadcom is next at 4.4%. Alphabet, which is Google's parent company, is also in there. Then we see companies like Old Dominion Freight Line, Humana, ConocoPhillips, Amphenol, and Steel Dynamics rounding out the top 10. This blend of tech giants with some industrial and energy names shows a strategy that is both growth-oriented and somewhat balanced. They are definitely leaning into technology, but not ignoring other essential sectors. When it comes to costs, this fund is pretty reasonable for a hypothetical $10,000 investment over the last 6 months. The cost came out to just $23. That is a mere 0.46% of the investment. This is a very competitive expense ratio, especially for an actively managed global equity fund. It suggests they are managing expenses efficiently, which is great news for investors. It means more of your money is working for you and less is going towards fees. Looking at the financial highlights, we see how the fund performed. For the 6 months ending the 30th of April 2026, the net asset value per S-share started at $26.12 and ended at $27.57. That is a solid gain. The net investment income per S-share was a positive 0.08. And the net realized and unrealized gain was a strong 1.42 per S-share. This resulted in a total return of 5.76% for that period. It is worth noting that past performance is not a guarantee of future results, but these numbers show a fund that was performing well during this reporting period. The fund's total net assets were about $22 million. While that might sound like a lot, in the world of ETFs, it is considered mid-sized. It means the fund is substantial enough to be liquid and efficiently managed, but not so large that it might struggle to move in and out of positions without impacting prices. The number of portfolio holdings is 56. This indicates a diversified portfolio, but not so overly diversified that it becomes difficult to manage effectively. The portfolio turnover rate was 32.9%. This suggests a moderately active management style. They are not constantly buying and selling, but they are making moves to adapt to market conditions. Let's zoom in on the detailed portfolio. They have significant holdings in the United States, accounting for almost 75% of their net assets. This makes sense given the strength and depth of the US stock market, but they are also venturing further afield. They have investments in Canada, Denmark, France, Germany, Italy, Japan, Poland, Singapore, Spain, Sweden, and the United Kingdom. This truly global approach is key to their strategy of capturing growth wherever it may be found. For instance, the holdings in Japan like Chugai Pharmaceutical and Itochu show they are tapping into innovation and established industries there. Digging into the operational performance for the 6 months ending the 30th of April 2026, we see that dividend income was around $101,000. Investment management and administrative expenses were $43,000. This led to a net investment income of $58,000. On the investment gains side, they had a net realized loss of $207,000, but this was more than offset by a significant change in net unrealized gain, which was over $1.3 million. This means that even though they sold some positions at a loss, the value of the stocks they held on to increased significantly, leading to an overall increase in net assets from operations of over $1.1 million. This filing also details how the fund values its assets. They use a tiered system, level 1, level 2, and level 3. Level 1 uses quoted prices in active markets for identical assets, which is the most reliable. Most of their assets, $18.3 million worth, fall into this category. Level 2 uses other observable inputs, and about $3.7 million are in this category. Level 3 uses unobservable inputs, meaning management has to make more judgment calls. and thankfully none of their assets fall into this category. This high reliance on level 1 and level 2 inputs means their valuations are based on market prices, which is a good sign for transparency and accuracy. One interesting aspect is their securities lending activities. They lend out some of their securities to earn additional income. They received collateral for these loans, and this collateral is invested. At the 30th of April 2026, the value of loan securities was around $171,000, and they held about $171,000 in collateral. This is a small but positive income stream for the fund, a smart way to squeeze a bit more return out of their holdings. Finally, the report discusses the approval of their investment management agreement. The board of directors reviewed the services provided by T. Rowe Price Associates and T. Rowe Price International. On behalf of the fund, they considered performance, costs, benefits, profits, and economies of scale. The management fee is an all-inclusive rate of 0.46%. This covers most operating expenses, simplifying things for investors and providing a predictable cost structure. The board found these fees to be reasonable after comparing them to industry benchmarks. This kind of oversight is crucial to ensure the fund is being managed in the best interest of its shareholders. Now, looking at this filing, the global equity ETF seems to be executing a well-defined strategy, a strong lean into technology, particularly cutting-edge areas like AI. Balanced with diversified exposure across global markets and essential sectors. The low expense ratio is a major plus, meaning more of your potential returns stay in your pocket. The high percentage of assets in level 1 and level 2 valuations indicates a transparent and predictable approach to valuing their holdings. The primary risk I am watching is the heavy concentration in technology, especially with NVIDIA. While it is a strong bet, it also makes the fund more vulnerable to a downturn in that specific sector. However, their diversification across geographies and other sectors does provide some cushion. What I'm actually looking for is continued strong performance in their top holdings and how they manage sector rotations if market conditions demand it. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord too.